request ma'am to come to the dais. So very happy to introduce today's speaker, SP Mathangi, fellow Chartered Accountant of our institute. She is having 25 years of experience in consulting and assurance service, registered valuer under IBPI. She is having hands-on experience in diligence and valuations for mergers and acquisitions for clients including listed companies and large business houses. She has handled 50 plus valuations of businesses across different industries, handling training sessions for valuations and accounting under IFRS. She is also expertise in assurance service including statutory audits, tax audits, certifications and international taxation. Experience in Ind AS implementation and working knowledge of accounting for financial instruments under Ind AS. She is also having exposure to IAS audits, hands-on experience using latest audit tools and multi-industry exposure. Ma'am is a physics graduate, postgraduate in artificial intelligence and machine learning from University of McCoy, Texas and Great Lakes. She is also Sivabogam Award winner for being the top lady candidate from Southern India in both CA and intermediate examinations. All India 8th rank holder in both CA final and intermediate examinations. So over to ma'am.
Good evening everybody. Good evening. It's 7th October, extension for income tax. I'm sure all of us under extreme pressure to be sitting here when we have our clients waiting there somewhere for something. Having accepted this, I have to do my job, so let's get out of this. So the topic for today, which has been given to me, is section 128, 129, 133, 134 of Companies Act and Schedule 3. The first 4 sections are rather simple sections, but with some new connotations which have come in the recent past with respect to maintenance of books in electronic manner, how to protect them, the edit log, trains, etc., which have to be maintained and all that. But Schedule 3 is a much bigger topic on which I would like to dwell a little more from my experience. Schedule 3 is, my topic is one, but then we have a separate Schedule 3 format for Division 1, Division 2, Division 3. I tried my best to cover all 3 divisions, trying to give what are common points among those 3 and what are the differences between the 3. Please feel free to stop me wherever you want, and please feel free to discuss the smaller notes of how you can have it can be a more interactive and a discussion forum also here. So section 128 talks about the books of accounts which have to be maintained by the company and where they have to be maintained. Who has to maintain, for which period to be maintained, and who can call for those records, what is the format, etc. So, the definitions of books of accounts, financial statements, etc. are given the definitions in the Companies Act. Basically, when they talk about books of accounts, they are talking about books of accounts, all other relevant documents. Books and papers means the registers, the vouchers, right from the vouchers to statutory registers. Any other registers, their sales, purchase registers, every book which contains the accounts and the financial statements, which will include the P&L, balance sheet, notes, audit report, etc. Everything which has to be maintained. So all these books are supposed to be kept in the registered office of the company. However, it also says that the accounting necessarily has to be on a roll basis and there has to be a double entry system of accounting. Now, the definition for books of accounts as given in the Companies Act will be books which will record the receipts and payments, all the costs, sales, purchases, assets, liabilities, etc. And papers include these vouchers, documents in writing, minutes, registers, everything, either in paper form or in electronic form. Financial statements will be the balance sheet, the P&L, the cash flow statements, the statements of changes in equity with UDS there, and all notes and schedules. All of that has to be there as part of financial statements. The exemption will be for the small companies and 1% companies, etc., who don't need the cash flow statements. For the rest, the cash flow statements will also be applicable. So if the books are not kept in the registered office, if it's not convenient to keep it there, then where else can be kept? So basically the board of directors of the company can decide where else other than the registered office the books can be kept, and once they decide, they will also have to litigate and file a form with the register of companies to say the address where the books will be maintained. And if there are branches, subsidiaries, etc., all the books may be very practically infeasible to come and keep in the registered office and maintain all that. So in those cases, the books can be maintained in the branches, respective branches or the subsidiaries, etc. But some kind of a periodic return or a statement or something giving the statement of affairs of the branch, etc. will have to be sent to the registered office, and those returns will have to be maintained in the registered office. So while we are saying they have to be sent, they are also talking about not changing the format in which it is originally received from the branches or the subsidiaries, whether it is electronic form or paper form, and that it has to be very legible and somebody can understand it, etc. The section also talks about maintaining the books for 8 financial years, for the 8 preceding financial years, and in case the company itself is a newly formed company, so for the years less than 8 years from when it was incorporated or when it is there. However, the central government can order the companies to maintain it for more number of years than 8, assuming there is some investigation going on or something like that. The books of accounts will have to be available for any director who may want to inspect the books. And if there are any branches or subsidiaries which are outside the India, they can request specifically saying what the director wants to read, and those records can be arranged to be provided for inspection. Any contravention, there is a penalty of 50,000 rupees to 5 lakhs. So while we are talking about manner of books to be kept, if it is in the electronic format, today in fact most companies, except the very small SMEs, and even the small SMEs, their accounting software, etc., are only in the electronic format. What is maintained in the physical format is probably some supporting vouchers or something like that. Otherwise, most of the records are only in the electronic format. So they are talking about electronic format also. So there, the recent amendments and circulars which have come in the NCA last year says that the audit trail will have to be maintained for all the transactions. The audit trail should not be, there should not be a possibility of disabling the audit trail. So from the experience which we had, the first audit which we have done after this was introduced now. So what we found was a lot of our clients are using Tally. So in the case of Tally, we found that the software providers, Tally, Zoho, etc., they have all incorporated the audit trail feature in the accounts. So some companies had actually, but I think in Tally, I think the user has to go and actually enable it. They have an option to enable it at a particular date they have not enabled. So somebody has done it on 1st of April, somebody has done it on 8th of April, something like that. It's not for the entire year. They also have this, you can also verify whether there is a feature for disabling the audit trail or whatever. The other requirement which is there in the NCA circular is about maintaining the audit trail for any changes to the database of the software. So, for example, in Tally, we find that the database is first of all not available to the user. At best, you can probably go and download it as Excel or something, but the user or the company does not even have an option to go and change anything in the database. Similarly, Zoho also, we found some of these companies like Zoho, because they are big and just quoting them. If you go to their website, they say how they are enabling the companies to ensure that this audit trail is maintained or how it can be verified, and also how the database access is actually restricted to the user themselves. So in the case of Zoho also, the database use is actually restricted to the users. However, what we found when we spoke to Zoho was that at the back end, Zoho can actually go and take a backup of your database if required, or they can go and make some changes. But I think it is restricted to some levels of executives. It's not available to everybody. Like we can't call a relationship manager or somebody and tell him, and he cannot make a change. I think it also goes for some authorization or whatever. And when we need a backup, I think they can actually take and give it to us. So the challenge this time in the audit was that each of these softwares, I think SAP and Oracle, Orion, etc., have not even talked about this feature, because if you are going to put an audit ring in the database, I think the system is going to hang. Every time you process a transaction, it's going to go forever. So I hear that a lot of petitions have gone from the CA fraternity and also the companies to say that there something has to be done on this database alone. So while we issued our audit reports, if it was Tally, we said the first two trains and edit log, etc. are available, but for database it is not available. So depending on the software, we have tried to speak to some of the software based to understand what they provide or not. So all of us are not really experts or anything on this. So we've spoken to them to try to understand what they are saying, and that is what we have put in some of the audit reports. The other things, the one other thing which relates to this, in the case of electronic mode, is the backup of the books of accounts will have to be, even if the server of the database is outside India, the backup has to be taken on a daily basis, and the backup server has to be necessarily in India. So, honestly, till we saw it in reality happening somewhere, we never realized, like Tally, Zoho, etc. are in India, so we know their backup servers are in India. But in a particular hotel, where the hotel software, like for example, if you take the Marriott group or any other group like that, which are all international brands and they are all managed properties in India. In one particular hotel, we found that actually the servers are in Singapore. So when we go for an audit and we ask for the accounts, they generate everything in PDF, Excel, and Word. So repeatedly our audits are based on the data which we get from there. So some of these sections are there in the books, and until we really see them, we don't know why they are there or that they are there at all. So in this particular case, we found that they quote confidentiality and so many things, and they are not willing to shift the database to India or even a backup server to India. They are willing to give only data to India. In one particular case, we had to leave the audit because we were qualifying and the client didn't want it. They said, no, this you can't say, nobody knows about it and all that stuff. But finally, we said we have to qualify, we have to, if they don't want a qualification, we have to resign kind of thing. So, this backup server, etc., I think we have to ask the client in case they are not Indian softwares, if there are any foreign softwares, we have to ask them to find out where the servers are and probably report on. So in the case of companies which are using service providers and maintaining records, etc., the companies also have to file an annual return based on who is the service provider, the internet protocols of the service provider, location where it is, whether it is India, where it is, whatever it is, and where it is based on cloud, the addresses which are provided by the service providers, who controls and these books of accounts and other papers in India. Also, the company has to file a return on all this to the registrar. In case of books which are maintained outside India, the accounting rules say that while generally the section talks about periodic returns being available from branch at the registered office, for companies which have branches or subsidiaries which are outside India, a quarterly return will have to be sent to the registered office. Here the periodicity is also mentioned here. And if the director wants the information, etc., the company should be able to provide it within 15 days of the request. So section 129 talks about financial statement. So they just don't say financial statement, they say that it has to be into a fair view and it has to be complying with all the accounting standards, etc. And it has to be in the formats which are prescribed in Schedule 3. The exceptions given are insurance company, banking companies, electricity companies which have their own format of accounting and all of that. And in every annual general meeting, the board of directors will have to present the accounts. While we are talking about accounts, we are talking about consolidated accounts where the company is a holding company. All other companies can present their standalone financials. And if it is a holding company which has a company above it and below it, then they can take an exception provided their holding company is providing a consolidated financial statements, in which case they can prepare their standalone financial statements. But even when they are presenting the consolidated financial statements, the standalone financials also have to be compiled and presented. So, any exceptions have to be noted and explanations have to be provided, and here also central government can specify certain class of companies, give exception or ask them to provide more or whatever. So while we are talking about, there is a section called 129A. Honestly, the first time I remember for preparing for this, talk about central government ordering some companies or class of companies to prepare interim financial statements or condensed financial statements, etc. Those also have to be in the same format as the annual financial statements. So the accounts of subsidiaries, associates, joint ventures, etc. have to be filed in form AOC 1 for the ROC. And consolidation also has to follow the Schedule 3 format. So section 123 talks about accounting standards which have to be notified with the approval of NAFRA. Now that NAFRA is there, it can be notified with NAFRA's approval. So as of now we have Ind AS 101 to 116 which are notified, and Ind AS 1 to 41 which are notified. So the purpose of this thing is to bring in some kind of a standardization amongst the users of financial statements, bringing in more transparency, the necessity for bringing in more disclosures for the reader as well as any other user, any investor, bankers who may be giving loans, etc. So that typically the requirement is to bring only that standardization. Section 134 talks about the financial statements that they have to be approved by the board before getting the audit report, and it also talks about the other notes and reports which have to be provided by the board report, the board responsibility statement, etc. So today we are in a place where a place of too much of disclosure. Honestly, I mean, we spend some time in audit, but we spend so much of time in the disclosure. So much of our time goes in that. So this section talks about all kinds of disclosures which the board has to give, which probably makes them take responsibility for whatever they are saying. So it's not only us we are verifying and saying, but they are also taking responsibility to say that they are taking care of financial controls in the company, the processes are there, the ESG statements, the technology absorptions that they have, the conservation of energy they have done, etc. So all those are prescribed under section 134. So the financial statements must be approved by the board, then their whole-time director, managing director, CFO, whoever is responsible, or anybody else if they are not there, in case of one-person company or whatever, and then it has to be taken, presented to the auditor for the audit report. So some of the salient features which have to be part of the board report will include the web address of the company, the number of meetings the boards have had. In case of listed companies or companies above 25 crores, they have to evaluate the board to see, it's an internal evaluation by the board of their own board members to see whether they are all qualified enough to be there, proficient enough, skilled enough to be there in the board. They have to talk about any frauds that have been reported. So these are all the number of committee meetings they may have had, the appointments, the remuneration of the board directors. So many other things which are other than the regular financial statements or the statements of affairs. CSR initiatives, risk management policy, related party transactions, approvals, all these will also have to be part of the board's report. Other than that, some of the newer requirements on conservation of energy or what they do. These have been coming up in the last few years. Then technology absorption, whether they are using imported technology or whether they have some for product development, cost improvement, product improvement, etc. R&D expenditures, etc. And then foreign exchange earnings and output. So apart from this, details of deposits which the company has accepted, whether they have paid, whether they were defaulted, whether they are what is the unpaid amount, movement of the deposits through the year, then maintenance and recording the requirements of the past records, compliance with the internal complaints committee under the sexual harassment of women. So all these are additional reports that the boards are expected to give. Again, for one-person company and small companies, there are some exemptions from some of these. So the board also has to take responsibility, like we say in the audit report, we have our responsibility, we also mentioned the board's responsibility. So in the board's responsibility statement, the board acknowledges its responsibility to say that there are accounting policies, accounting standards which are necessary to be followed. The internal controls are all in place in the company, and financial statements are prepared on a going concern basis. And there are proper systems to ensure that the laws and regulations have been complied by the company. So, the most important thing to cover for the day is actually the Schedule 3. So, over the last few years, some new changes have been made to the Schedule 3. Every year there are some additional disclosures which have been added based on the frauds or anything that count. I think MCA keeps on adding some requirements there in terms of additional disclosures, etc. But broadly, the idea is that there is quite a bit of transparency in reporting what happens in the company for both the listed companies and for others also. So here also the exceptions to Schedule 3 are banking companies, insurance companies and electricity generation companies, because they have their own act under which a specified format is prescribed for them. So they will be preparing accounts in that format. All the rest of the companies will follow the Schedule 3 format, including interim, condensed financials, review financials. Any of that will also be in the Schedule 3 format. Only the number of disclosures or the extent of disclosures will change for interim financials, etc. So the Schedule 3 is actually giving the minimum set of requirements that will have to be followed while the company presents its financial statements. It is not really exhaustive. We can actually give more information if required. Not that we want to, as it is, we are giving too much of information there. But the objective is that at least those minimum set of requirements are given. So the definitions which are there are broadly the same definitions which are there in the Companies Act. While we prepare the disclosures, the company prepares the disclosures. I'm just saying that practice B because mostly we do it for accountants by habit. So, what we have to focus on is that we are not giving too much of information to confuse the reader, at the same time something which is not there, yes, that somebody does not understand the financial statements also. So some kind of a balance is required while we prepare the disclosures. Some of the key things that are common to all divisions of financial statements are like rounding off which has to be done. And once we have decided to round off the nearest lakh or the thousands or the millions or the crores or whatever, the same rounding off or the units have to be followed across the financial statement. So it's not just in the balance sheet P&L notes, the subsequent disclosure notes, wherever we are giving, like for example, out of book things like contingent liabilities, commitments, wherever we present numbers, if it is crores, we have to follow it through crores across the financial statements. So whatever we decide to use, that has to be fully followed through. Additional features that we are giving these days are on the shareholders. So, who the promoters holding. then shareholders are holding more than 5% in the company, then reconciliation of equity. For most of the items like provisions, reserves, equity, we find that there is a movement that we give in the statement from opening to closing, giving a reconciliation between the opening to closing. Even change in shareholding, from last year to current year. Whoever were holding 5% last year, who is holding more than 5% this year. So those movements, new allotments of shares, reduction in shares, bonus, buyback. So all those disclosures we are giving now across all companies. Some fundamental definitions are also given. Like earlier we used to put, the latest generation of CS may not be knowing, but when we started the P&L balances, the debit balance in the P&L loss used to be shown in the balance sheet in the asset side as a debit balance in P&L. Today it has to be shown in the negative in the reserves and surplus only. So these are some changes which we have seen from the earlier Schedule 6 to Schedule 3 now. Preliminary expenses. And trade receivables will include only receivables which are actually emanating from trade. So they will only include for sale of goods or services, etc. They giving aging of receivables, aging of payables, and then if there are earlier, it used to be based on we generally say aging. Today we say we are talking about aging from the due date for the receipt, etc. So some changes which have come to the past. Capital advances are separately given under loans and advances. They have to be included under CWIP. Then we have to disclose contingent liabilities, capital commitments, other commitments also, not necessarily capital, even other commitments. Then restrictions, rights of shareholders for all class of shareholders. In terms of loans, we are giving probably the terms of payments of loans, interest rates, talking about defaults, whether they are regular, etc. And all items of income or expenditure which exceeds 1% of the total income or 1 lakh has to be put as a separate line item in the financials. So this used to be earlier 1% of revenue, and it also used to be 5,000. So finally, I think some sense prevailed and said 5,000 is a very small number. We can disclose everything and they made it 1 lakh. So the structure to Schedule 3 across all 3 divisions is actually giving a general instructions, then the form of the balance sheet, the instructions for preparation of the balance sheet, then we have the form for the P&L account and the instructions, and finally instructions for the consolidated financial statements. So Schedule 3, actually we have 3 Schedule 3 formats. Division 1 actually pertains to the companies which don't follow Ind AS, basically unlisted entities and others. So this is following our regular ICAI financials. So that comes under Division 1. The Division 2 is for listed companies and others, or companies having net worth over 250 crores which follow Ind AS. And Division 3 is for NBFCs. So if we look at the structure, we can actually see some kind of a distinct difference between the 3 structures. Okay, so that I already said. And whichever division our financial statements will follow, if it is Ind AS, the subsidiaries, associates, joint ventures also, even if they are smaller in size and directly the Ind AS is not applicable to them, they will have to follow the Ind AS of, because the holding company follows Ind AS, these companies also necessarily have to follow the Ind AS. So either they will come under Division 2 or Division 3 depending on the business. So Division 3 is for NBFCs with net worth over 250 crores. Originally, this was intended when Ind AS implementation was supposed to have been done for banks also, but I think it is always only I don't think they will take a call until this. People understand the effect of fair value. I don't think we will get Ind AS implementation for banks. The testing has been done with NBFCs. So Division 1 financial statements, I've given a more detailed detailed explanations and everything at the back, so just to go with the format. So Division 1 talks about equity, non-current liabilities and current liabilities. So essentially here, the assets and liabilities are split between current and non-current based on the period of maturity or the realization or whatever. Other than that, you have equity. In case of Division 2, we find an additional component added to it. There is a current and a non-current. But additionally, you also have what is called as a financial asset or a financial liability, and a non-financial asset and a non-financial liability. So, this also is in the similar order, only like Division 1, that it follows from non-current assets to current assets and non-current liability to current liability, and then you have equity and the other equity, and in the P&L you have another comprehensive income, etc. But the most important difference will be fair value of financial assets. So you have the concept of what is a financial asset and what is a financial liability and what is a non-financial asset and a non-financial liability. So this Division 2 financial statements give importance to the financial asset and the non-financial asset or liability. The Division 3, which is for NBFCs, because they are financial institutions, again they have financial assets and financial liabilities, but if you look at the order, it will be in the order of liquidity. So essentially it is also same as Division 2, but the order that will follow will be in the order of liquidity. So all financial assets which are highly liquid, like cash, bank, etc. will be on the top. Then they will be followed by non-financial assets, and in terms of decreasing liquidity. So basically the difference between the three divisions is, one is completely different in terms of the accounting standard which it follows. 2 and 3 follow the same set of standards, but Division 3 being for financial institutions will follow the order of liquidity. So that is the difference actually. So for convenience, I thought we will discuss the common features of all the Schedule 3s, 1, 2 or 3 mostly, and then we can go and look at Division 2 and 3 where something more is required or there is something different. So rounding off has been now kind of commonalized to say that whenever the total income is less than 100 crores, you can round off all the numbers to the nearest hundreds, thousands, lakhs or millions and decimals. And when the total income is more than 100 crores, we don't have hundreds or thousands, we start with lakhs, millions and crores. So here we are not talking about revenue, we are talking about total income, which means you have revenue from operations and other income put together, and on that total income, if it exceeds 100 crores, we take this call. So once we have decided this, previous year numbers, notes, schedule, whatever we call, right till the last note saying where previous year numbers are proved as necessary or whatever, in every which place we are going to mention amounts, it has to be in the same number. So we start in crores, the entire financial statement has to be doing numbers in crores. So we can't have somewhere in crores, somewhere in lakhs, etc. So before deciding what to use, the common thing that we generally try to see is, if it's a small entity which contains numbers only in thousands or something, rounding it up to a lakh and putting it there, many numbers will not even appear in the financials. Most of them will come as this, 0.00, 0.01 or something, and we can't make sense of it. So depending on the size of the business, we can decide how to round off. Having said that, it is extremely inconvenient to round off something in hundreds. I found that after somebody did that only, I realized that whenever you read that number, we read it wrongly. Somehow I think we can read in thousands or lakhs, but I don't think we can read in hundreds. It's extremely difficult. The current asset, current liability definition actually follows from the operating cycle of the business. So generally, take it as 12 months. So basically, when you acquire the asset, you do a business with it, you sell it, and then you realize it. cycle is supposed to be one operating cycle. So it is generally taken as 12 months, but not that it is fixed or something. So depending on the business, it can be more than 12 months. Like agriculture could be something different, manufacturing could be something else. So depending on that, the operating cycle is decided, and based on the operating cycle, we have to see whether it is current or non-current. So it's though there is a definition and a guidance, it is not really etched in stone or something. It can be changed for businesses depending on the business view. And in cases where a company is into multiple businesses, those businesses actually could have some different operating cycles for different businesses which they have. In those cases, for each business, we can actually go and classify the current and the non-current. So non-current is actually not really defined anywhere. Basically, it is like residual. What is not current is non-current. So some examples of current assets are inventory, trade receivables, cash equivalents, etc. Liabilities are like trade payables, salary and operating costs which have to be paid immediately and all that. While we are evaluating current and non-current, since some of these standards are not, all the standards are actually based on IFRS. So, for example, if you take bank loans, if they are repayable on day one itself, on demand, then you treat it as current. If they are otherwise, if you have a term loan, you look at the repayment schedule to see whatever falls due within the 1 year, the next 1 year or the next 12 months, you call it as current. Or what falls due after 1 year, you call it as non-current. But in some cases, what we will see is banks have bank covenants. Whenever they have loans, they also have covenants. And normally, when you read the sanction letter which lists out the covenants, it will say that if you fail following some of these, fulfilling some of the covenants, the loans will become repayable on demand. So in IFRS, what happens is, if the loan covenants are not fulfilled by the bank, by the company, then automatically they become repayable on demand, and in IFRS, the loans where the covenants are failed will be actually called as current loans. Whereas in India, time and again we know that these bank loans are all running only based on relationship, not necessarily on covenants. So in case the covenant which is not fulfilled is a minor one, like for example, the covenant says that whatever you fail, it will become on demand. But supposing you don't file a stock statement, or you don't file a quarterly return or something like that, you have still failed the loan covenant, but the bank is not going to foreclose the loan and ask you to pay immediately. But there could be some very serious financial crisis where they don't pay the loan, or they don't follow or do something which is required in the covenant, where the bank can take a call and ask the company to repay the loan immediately. So in those cases, the loans will have to be treated as non-current or long-term borrowings, and there we know that despite the failure, there is going to be no, I said wrongly. So where it is going to be called back immediately, then you call it a current loan. Otherwise, you call it as a non-current loan. So it only has to go by experience that the company has with the banker and whether it will get called or not, depending on the kind of failure that the company has had. Similarly, in case of employee benefit obligations also, now we take the actuarial report which generally gives the obligations for gratuity as short-term or long-term, depending on the expected retirement rates and how many people could probably retire during the year. So the actuary gives us the report in which case we follow this. But there are cases where people may not have an actuarial report, or cases where the gratuity is not funded. But we know we have estimated the total gratuity. So in those cases also, how do we take a call on this current or non-current is dependent on, we have data on how many people will retire in the next coming 1 year based on their age or whatever criteria. Then any gratuity that is payable towards them, we can bifurcate as current. So based on the data, we need to do some kind of analysis to understand how you can split it as current or non-current. Bonus which is payable immediately can be current, but if it is payable much later subsequently, it can be non-current. So each contractual payment we need to understand when it is payable and decide whether it is current or non-current. Similarly, in terms of investments also, there is a difference from AS 13 to Schedule 3. So generally, we call it as held for trade in AS 13. Now they are called as realizable within the next 12 months or so. So even long-term investments, by nature, which were originally long-term but which will mature within 1 year, will have to be treated as current year. So under each item, the extensive disclosures that are required under Schedule 3, we can look at that. While we talk about share capital, we have to now give the promoter shareholding. We have to give details of shareholders who are holding more than 5% of the shares. Whatever disclosures we are giving, we have to give for each class of share also. For every preference share or every equity share, everything we have to give this. Reconciliation of the number of shares outstanding in the beginning and in the end of the reporting period. Holdings in shares held by subsidiaries or associates, cross-holding, etc. Those also have to be given. In terms of securities, if they are convertible securities or redeemable preference shares, convertible preference shares, those in terms of conversion, valuations, whatever we have, those details also have to be given. While we talk about reserves, so reserves will have to be given as capital reserves which are not available for distribution, capital retention reserves where we actually create a reserve for redeeming the preference shares or debentures out of profits. Then any buyback which has happened from the free reserves, securities premium account, debenture reserve, redemption reserve, then revaluation reserve which comes from fixed assets, property, plant and equipment revaluation, then share options outstanding account, share price payments, any other reserves, and P&L surplus. So for all the items that are listed under the reserves, this is the minimum reserve. So that's why I think in every head you will see one word called as other. So that gives us an option to add any more items that we want to add there. So for each item that is given there, we need to give the reconciliation between the opening to closing, what is the addition, deletion, adjustment. For example, you have a business combination, some merger amalgamation that has happened because of which some item has added. Those also have to be specifically mentioned and added. Now, share warrants and share application money. So we generally have one line where we say share application money received pending allotment, which we put under the equity and the reserves. After that, we add that line. Now, in Schedule 3, now we can put it there only provided we know the number of shares that are going to be issued, whether the authorized capital can actually accommodate those number of shares. If the authorized capital is not sufficient to accommodate the shares to be issued against the money which is pending allotment, or alternately if the monies have to be refunded back to the person who has given the money, etc., those will have to be taken to other current liabilities. So only the amount which is fixed and we know that is going to be allotted to the shareholders, including number of shares, etc., can be shown under monies received against, share application money pending allotment. Similarly, share warrants also. If you have received any monies against share warrants and subsequently it will be exercised and shares will be issued, they have to be separately disclosed. So non-current liabilities, like I said, only current is defined, non-current is not really defined. What is not current is all non-current. So under non-current liabilities, we generally have long-term borrowings, which are your term loans, etc., then deferred tax liabilities, other long-term liabilities, and long-term provisions. Long-term borrowings are further classified. We have to, for every class of liability, we have to give them whether it's a bond, it's a debenture, if it is secured. So the disclosure happens on 4-5 things. It talks about the money which is the type of borrowing or whatever. Then it goes by security to say whether they are secured or unsecured. Then if any of the transactions are between related parties, those also have to be specifically separately disclosed. Then any guarantees etc. have to be separately given. Repayment terms for all loans, interest rates etc. also have to be given. And with the latest thing, last couple of years we are also talking about whether the company has been called as a willful defaulter, and if the default is continuing at the time of the balance sheet date. So any default which happened during the year but which has been corrected within the year need not be reported here. But if the default continues on 31st March or the reporting period end, those also have to be reported under the borrowings. So we have to specifically give maturity dates etc. So what we find in many cases will be like the directors lend money to the company. In those cases, sometimes we will find interest rate, sometimes they will be interest free, and in many cases the repayment terms will not be fixed or anything. So basically then we state that and say that repayment terms not fixed.
With respect to the willful defaulter aspect, this is purely from a Schedule 3 perspective, but from an audit perspective, for the audit evidence, do we get a confirmation from the bank on whether the company is a willful defaulter or not, or how do we take it forward?
See, most of these cases, banks will classify the company as an NPA or something.
Okay. That will be available on the rating website, or we will get it as part of the confirmation?
I think what we get is only a confirmation. Probably we have to inquire more. Anyway, the schedule will say whom RDA has called as a willful defaulter. So probably they are called, we don't know. So I think while we take the bank confirmations, and while we are saying, while we see the defaults, because anyway we are seeing whether under CARO we are also talking about whether the repayments have been made or not, etc. I think when we see that the defaults are there, probably we have to inquire more to find out whether they are defaulters, willful defaulters.
Default is not willful defaulters.
So the security for the loan also, we have to, if it is generally for each loan there could be a different security, then specifically it has to be mentioned. For example, we have a vehicle loan which is secured against the vehicles. So we cannot generally put one statement, put all the loans and then underneath that say secured by assets of the company or secured by all current assets and fixed assets, or some generic statement cannot be made. So for each type of loan, with each bank or whatever, we need to put it separately. Now I think mostly, except for term loans, mostly because of the RBI restriction, I think most companies will have only one CC account or something, and most accounts will be linked to that. But it is very important to go through individual sanction letters to find out what securities are offered, and we need to put there. Apart from this, for the borrowings, there is also a separate clause on which we report on saying that the charges are registered, or once the loans are closed, the charges are being satisfied also. So it is also good to look at the MCA website to see in ROC whether these charges are paid and whether they are satisfied and all that. So what will come under non-current liabilities will be some deferred liabilities. Like for example, the company agrees to pay somebody much later for acquisition of property or machinery or anything like that. And deposits which are accepted from public, which are paid which are payable, maturity is much later, more than a year old. Those will come under non-current liabilities. Here also, in every clause, wherever there is a loan or a transaction from a related party, the related party distributions also have to be mandatorily due. So, apart from that, under long-term liabilities, you also have any contractual obligations which cannot generally be included under the trade payables. Like this could be for any contractual payments, yes. And then earlier they have also put trade payables under that with the classification of MSME and others. But I think in long term now we cannot have MSME with this new thing coming that even if the MSME will give you a credit period beyond 45 days, the maximum credit period allowed is only 45 days with from this year. We've started already. So all MSME vendors will have to necessarily come only under current liabilities. Provisions against witness long-term and short-term. Employee benefits will come there. Other provisions will include like for example, short-term provisions will include some warranty, stuff like that, or tax provision, etc. So current liabilities are short-term borrowings. Short-term borrowings also including one based on the maturity itself, the others also based on the current maturities of the long-term loans. So any loan which has a tenor of say 3-4 years from now for maturity, the first 1 year's installments alone will be clubbed here under short-term. The rest will be what is due after 1 year will be put under the long-term. Trade payables which are outstanding, the bifurcation is between the MSME and the others. So this year the challenge was on the MSMEs. Generally we put a note saying we are interested. So whoever told that they were MSMEs have been brought in and recorded in the books and interest have been provided and all that. In some cases we found the MSME interest, we found that companies actually make a provision for what is outstanding in the year end. But during the year, wherever they have paid them after 45 days, so even in listed companies, while we read and when we heard, we found that they actually make a provision and reverse it at the end of the quarter. Again make a provision in the next quarter. Apparently many of them don't pay the MSMEs, the interest portion. So I am not sure how this is going to pan out. Because all these years this was not taken very seriously. Now we are seeing that under income tax it is going to be a disallowance and we are heavily disallowed in some of the cases. In this particular case, the reasons which are being quoted are like, for example, it's a quality issue. So the MSME vendor was not paid because the service quality was very poor and there is a dispute or not necessarily a dispute, but there is a negotiation which is going on with the vendor to say to correct the quality issue because of which the company has not paid the vendor. So in those cases, other companies obviously won't make any provision during the year, but listed companies also, they make a provision, but many of them don't pay the MSME vendors. The interest does not get paid at all. So during the year, every quarter they make their reverse, they make the provision, they reverse. And only the year and finally we have a provision. I am not sure whether they will be paid. Whether it is short term, long term, in all cases, whatever is the security that is being offered has to be disclosed. Any guarantees given by directors for the borrowings, those have to be disclosed. There is also a recommendation that where the borrowing has both a short term and a long term component, we have to tabulate it in such a way that somebody understand which is the total borrowing outstanding. So what we have seen or what we have seen in some cases is under the long-term borrowings itself, the entire table for that loan including short-term borrowing is given. The split is made in the table saying this is the total loan, this is a short-term portion, this is a long-term portion. And if you see the financial statements in the balance sheet phase, the same note number will be referred across both short-term borrowings and long-term borrowings. Both will refer to the same note. The bifurcation will be given in the same note itself. So, trade payables, long-term trade payables, I think can't have MSMEs, but anyway, short-term trade payables, we also have given aging of the payables based on the last 3-4 years, based on less than 1 year, 1 to 2 years, 2 to 3 years or more. And further, we also classify them as MSME and others. And within MSME and others also, whether they are disputed dues and undisputed dues. Apart from that, we are also giving the MSME disclosure under the MSME Act. So, the principal and the interest which are outstanding, what has already been paid to them and what is outstanding and not paid to them, what is due and payable, and any amount which is accrued and remaining unpaid, and future interest due and payable in the succeeding year. So, all these are disclosures we are giving along with the trade payables. And whenever we give these, this thing, you have to remember that we have to give every disclosure for the previous year also. So, other current liabilities include current maturities of finance lease obligations. So, any lease we have taken, finance lease, those which are payable within the next 1 year, they are classified here. Interest accrued but which are not due, and due but within the next 1 year. Then income which is received in advance. So, customer advances, unpaid dividends, application money for allotment of securities, unpaid matured deposits which we have, deposits we have received but which are unpaid but they are matured already, then unpaid debentures, etc. and others. So all those are classified under other current liabilities, mainly because they are expected, they are already due and they fall due immediately. So they are payable immediately, so they are all clubbed under the current liability category. So short-term provisions will be for employee benefits which will come from your actuarial reports for re-encashment or gratuity, etc. Provision for dividend, taxation, warranties. So warranties is again an estimate which we make and project it and kind of arrive at the numbers. So on the asset side, sorry, everybody wants to ask anything, discuss, please feel free to do so. Any questions? I'm little new to this, not asked earlier. Anybody has any questions or want to?
Just
yeah.
not very technical, but not very technical question. See, when we used to have preliminary expenses on the other side, we used to see how we have research and others part of westernization or part of complaints or us adopting India's papers, all those things, or because definitely I think our what we practice way of looking at things. You expend something and you treat it as an asset. You take a stance that an expense is part of the long-term going concern of the business. Why we have to put it on the line? Why was it changed?
I think it is to bring some uniformity across all standards. And the second thing is the asset side is something which is expected to bring some benefit or whatever out of this. So honestly, these are not really assets. They are debit balances clubbed as assets.
Not maybe from monetary point of view.
Correct.
You were saying about the loan amount turning to be, there's been a default in the weekend. We just classify it, we just qualify the default in our audit report. What do you suggest?
No, the disclosure, we are also talking about giving the details of the default, nature, right, how long it has been defaulted, any reason, any stand that is taken. So, particularly the, I think the listed companies have their boards who are also interested in the disclosures and everything. And I think in the smaller companies, they come and tell us that if you put this disclosure qualification, banks will not give us loan. I mean, you had request where they say, no, madam, banker is asking you to remove the qualification. I am not sure in whose interest they come and tell us such things. We are listening to all that, and then we have to, I mean, we tell them very nicely, no, sir, we have to put it there. I'm still not, one report is pending because, they want, the thing they are saying is banker wants the qualification to give. So, I mean, when they say the banker, it is obviously the local branch person who is saying this. Maybe a couple of years later he will go away and, the company does not repay the loan. Somebody is probably going to come after us saying there is public interest in this, there is a bank loan and the company is not doing well, why have we not qualified, obviously. So I think
in that case, can the opinion not be based on the promoter's risk and not on the company? If we are giving a qualified opinion and the banker wants risk to be more in terms of his liability, and that this not be compensated on the personal side of the business rather than the business itself. Or otherwise the loan should be rejected.
they should not give the loan. So
Right.
they want to give, that is their business, they want to give loans. So when they don't repay, I think they will come to us. Somebody does not repay, they will tell us what were the auditors doing. No, I think the tone is anything happened to what the auditor.
Yes.
So actually very tough. So
Easily we take the blame.
it's laid at somebody's feet. Who is not responsible for this?
Suppose if the business and it's actually B2B, the company and the bank, it's B2B, the audit is only 20% is completed. The entire is false on him, and he's 40 and 40. I'm just giving a clear picture. That falls on the audit just because it's not good for financials and at least to walk away. It's not fair.
Absolutely not fair. Unfortunately, after this, we can't change our no, we can't change our profession also. We already been there too long. Every day, one new disclosure or something comes. It's becoming a nightmare, I think, more for us than anybody else. So, seriously, you look at one company with, I think there are hardly any transactions. But if you go and see, you start wondering, maybe what they are doing will make it an NBFC or something. Or, I mean, we are supposed to be thinking in 100 angles, because if you don't put it some report, then sometimes we also think, oh, thank God the RO is not there. So at least somebody will not ask us what happens in the company. I hope all that does not become. Actually, if you see the audit report, which is a one-page audit report, has now become 5-6 pages already without the RO. So they are reporting on so many things.
They will not get paid from the government or something. Both jobs and both.
All of us wish. Too much. Actually, too much. Actually, it is, we spend 1 month looking at the company or whatever. See, I am also on the other side. I am also in the board of a listed company and all that. The thing is, I think either this way or that way, the amount of information that we will get is very minimal. The amount of digging and analysis and everything that you have to go to unearth what could probably be happening is enormous actually. So, I mean, to digress, I had a company which had a fire 2 years ago. So, the first year, I think the fire happened in November 22 or something like that, and they told us in December December there was a fire. They said, okay, a surveyor has gone and he has verified everything. So last year, till September, we were waiting for some surveyor report or some insurance company to see that the claim has been admitted, so that we will have some proof of the amount of claim that can possibly be there. Because the client says that he wants to take it to income and book the claim receivable and also book the exceptionals of fire. So we waited and waited and waited until September 30th, nothing came. He said no surveyor is expecting some money or something, he has not given the report. But there is a FIR which they have filed with the police department and also we know it has happened, but the amount of loss, the amount of claim we have gone through. So last year we just put a note. And then from last September till this September, every month, I know that this year also I have to do the audit. So every month we have been pursuing the director, the company promoters. Every month we have been calling them and asking, can you please tell whether the insurance claim has been admitted? Has the surveyor given a report? So till 23rd September, I didn't get any data. And it's a huge sum considering the size of the company. So I'm not sure whether they are expecting that 30th September again they will come and negotiate us with us and tell them, madam, please, this year also we didn't get any paper or something like that. So I just thought about it and said, okay, let me only give a draft qualified audit report. So I sent a draft qualified audit report saying this much of loss is there, so I am unable to express an opinion on the recoverability of the claim. I just put that and sent it. Next day, he has talked to the insurance broker, he has talked to the surveyor, and then one letter he brings to me and says that the surveyor has submitted a report to the insurance company. From November 22 till September 23rd September 24, I have been following the paper. I have not even got my fees for the last 2 years, that is different. But more than protecting him, I have to protect myself. So I have to do so much of work. Either I am happy to resign, but he says, no, he does not want us to resign also. But I'm not sure whether it is worth the effort. So just to protect ourselves, we have to follow so much. And after he gave the paper also, I am not very sure whether it is because he has not given it to me for 2.5 years. Suddenly one paper comes from the I give a draft. It is also dated 24th September. So he brought Verday's letter only. So I tried to call people whom I know. I knew in United Insurance just to find out whether the claim has actually been submitted, not even about the amount. Because they may not tell us the amount. I think insurance company, if they agree on the amount, that they may have to pay or something. So definitely they will not confirm the amount. But I really had to call so many people whom I knew, and finally they said, yes madam, there is one claim. So finally I decided only to revise the qualification, not drop it, because still I don't know the amount. But see, they don't, in this particular case, the banker has been saying drop the qualification. Because I think after the fire, the bank has lent heavily to this company. The company has still not revived. They have not come out of their losses fully or whatever. So I think the branch will have to report to the zone or region has to report to zone or whatever. So finally they want to audit the companies. Very unfair actually. This is how it is. Okay. So non-current assets will include property, plant and equipment and intangible assets. C1, intangible assets under development will have to come separately under one line, depending on whether it is actually eligible to be classified as an asset and left there, whether it has crossed the research phase, development phase, etc., and whether the product is definitely going to come out of it and all that. Long-term advances and long-term assets. So So in the case of property, plant and equipment, again the split is, these are earlier called as the tangible assets or fixed assets. So land, building, plant and machinery, furniture, equipments, office equipments, vehicles, etc. and others. So we have to give the useful life for the assets based on which the depreciation is measured. The method of depreciation can be straight line or WDV. Here also we have to give the movement of the assets as well as the depreciation from opening to closing. Any revaluation adjustments will have to be given and also stated for 5 years that revaluation happened and how it was valued, how the revalued numbers were arrived at, whether an independent valuer had done it or whether the company had revalued, etc. Assumptions, valuation techniques, everything has to be disclosed. In this case, any assets which are acquired out of merger, amalgamation, etc., those also have to be disclosed. Now, we also have to report on properties for which title deeds are not available in the company, other than leases. So, we need to say why the title deeds are not there, what are the steps taken, when it is likely to happen, etc. Apart from this, there is a disclosure on Binami transactions also if there is any proceedings. In the case of CU, capital advances cannot be given here, they have to be given under long-term loans and advances. We have to give aging for CU and a separate disclosure on aging. Apart from aging, we also have to give details of where there has been a cost overrun or a project overrun, the project is not completed within the time. Then we have to give additional disclosures for those also saying when it is expected to complete, whether it will happen in the next 1 year, 2 years, 3 years, or when it is likely to be completed, and the amount which will have to be committed by the company to complete that CU. So with respect to Binami properties, if there have been any proceedings initiated against the company, then we have to give details of such property, when it was acquired, then the details of the beneficiaries whose assets we are holding, amounts. If the assets are in the books, we have to say reference to them and say where they are in the books. If they are not there in the books also, we have to say where they are. Then what are the type of proceedings, the status, and what the company's views on the same. So intangible assets, we have goodwill, brands, trademark, software, mining rights, copyrights, patents, licenses, etc. Intangibles cannot be revalued. Intangibles which are acquired can be accounted in the books or it can come out of business combinations. Here also we have to give a recall on opening to closing. Intangibles under development have to be separately shown. However, we need to get some kind of a cash flow projection or whatever. Even otherwise, we need to get a cash flow projection or whatever in case of intangibles to see whether they will be impaired, whether they will actually become an asset, etc. And only after that they can be classified here. So, next item of asset is the investments. So, investments are classified as current or non-current depending on maturity. Apart from that, you also have investments in investment property, equity instruments, preference shares, government trusts, etc. So, wherever the investments are, based on that, whether it is quoted equity, whether it is unquoted, unlisted shares, then what is the market value of share, etc. All that have to be given. Now, in Schedule 3, in Division 1, we will only have to record everything at cost or net market value, whichever is lower, and provide for diminution for investments. Permanent diminution in case of, like for example, subsidiaries, etc., where we find there is a heavy loss, etc., we are providing for diminution. We'll have to mention that. If you feel the diminution is temporary, then we have to make a note and say that though there is an erosion in the value, we are not provided because it's a temporary diminution. And overall quoted market value, total value of the quoted investments have to be given separately. The fair value concept is not there in Division 1, so we go by cost or market value, whichever is lower. Roles and advances, long term or short term. So capital advances will come under this category. Here also, whenever loans and advances are given to related parties, we have to mention this. We also have to do a disclosure based on whether they are secured and considered good. So in trade receivables, loans and advances, everywhere we have to say whether they are secured, whether they are considered good, or whether they are doubtful, etc. Those have to be mentioned. Any loan to a related party has to be given. Terms of such loans also have to be given here. Security deposits, rented deposits, etc. will also come here. So trade receivables, we have to classify them based on outstanding from the due date. If the due date is not available, Schedule 3 says we can go by invoice date. Provided it is not mentioned anywhere, then we can go by invoice date. So the aging will be from less than 6 months, 6 months to a year, 1 to 2 years, 2 years to 3 years, 3 years and above. And other than aging, you also have to say whether they are undisputed or whether they are disputed, and even indisputed or undisputed, whether they are good or whether they are considered doubtful, and if they are secured, mostly they are unsecured. In the case of unbilled dues, basically the work is done, we have recognized revenue, but we have not billed with customer. Those also have to be disclosed separately by line item, and here also we have to provide details. Inventory are classified under raw materials, WIP, finished goods, stock in trade, stores, spares, used tools, etc. And if you have goods in transit under any of these categories, under the respective category, the goods in transit also has to be
check.
And
Check.
somewhere they are checking.
Check.
Actually, when they gave the
Check. One. Check. On that one, on board mix. On the mixers one. Then we'll have to find out which is one and connect that to. I got one more here.
It's a small one.
Check. Four. Check. 1, 2, 3, 4. Check.
Secrets. They have a very good way of ensuring they don't sleep also. Actually, when they said 3 hours, I said, okay, audience will sleep is okay. If you tell 3 hours, I may also end up sleeping. CPE, worry. Okay, so cash and cash equivalents will be bank balances, checks, drafts, cash, checks in hand or drafts in hand, cash in hand and others. So here what happens is sometimes we have bank deposit balances, but these have been marked with a lien, or they have been provided as margin money, or they have been provided as security, etc. So this is really not cash available immediately for us for use. So these have to be specifically disclosed with details of lien mark, amounts, etc. Similarly, when something has been provided as a guarantee or where we have a loan against the deposits, etc. has to be mentioned here. And if bank deposits have a maturity of more than 12 months, though it is bank balance only, it has to be specially mentioned here. It is not really called non-current, but it will come here and with a separate line item. The last classification you have in the current assets, which are other current assets. So if the asset does not fit anywhere in any other head, then it comes under other current assets. So apart from this, outside the books we have contingent liabilities for which we have to give details of claims which are not acknowledged as debt, guarantees, and other money for which money is contingently liable, and contracts which have to be completed and the estimated amounts to be spent. So other disclosures that we are giving in Schedule 3 now for all companies will include defaults in loan repayments to banks or financial institutions, company being declared as a willful defaulter, then the related clauses, what happens, what is the status, etc. The relationship with struck-off companies. So that is another big, ROC has MCSIs give data, but we have to probably go by each MCS site or something, ROC by different ROCs to find out which are the struck-off companies, etc. and find out whether there are any transactions and we have to report on that. Then registration of charges or satisfaction of charges. So normally when they take a loan, then immediately within a month or so the registration must have happened to register the charge. Similarly, when the loan has been repaid in full, the charge has to be satisfied. That also has to be filed within a month. If that has not happened, it has to be reported. This generally we can look at the ROC site itself for charges. We will know whether the charge is there or not. Then there is a restriction on number of layer rules 2017, which talks about you can only have up to maximum of 3 layers as subsidiaries. And that too, I think you can have only 3 layers of subsidiaries. The exception is that if one layer is a wholly owned subsidiary layer, then one more layer will be allowed. But in that case also, if you are having a company, then under that you have one wholly owned subsidiary, and again under that another wholly owned subsidiary, only one layer will be treated as an exemption. So this I think is there to ensure that you have a lot of shell companies, money is being diverted, invested across companies. Finally, nobody understands what's happening in these companies, etc. To kind of control it, I think this law is there. So whichever companies had these layers before 2017, before these rules came into place, they were expected to report on it and correct it, and they were given some time. Subsequently, after the rules came into place, the companies are not allowed to open a 4th layer subsidiary. This is not applicable to associates, joint ventures, etc. So if you put probably a company, a tree kind of thing to see who is holding how much in what, etc. Only if they are subsidiaries, it will come under this. Then wherever you have borrowed funds or a share premium which has come in and we have invested further down, 1 layer, 2 layer down, etc. So there we have to give details of the transactions, who are the ultimate beneficiaries, etc. So the end use of the monies we have borrowed has to be given here. Then we have to give different ratios, current ratio, debt ratio, debt service coverage ratio, inventory turnover, receivable turnover, return on equity, etc. And all these ratios we have to give for the previous year, and all variances also have to be explained in detail. So when it comes to statement of profit and loss account, revenue from operations will include only sales, services and other operating revenues, like for example scrap sales, which comes out of Our main business, but which we sell and make money, comes under other operating revenues. All other monies coming from investments, dividends, interest, all that will come under other income. And all non-operating income will be accounted as net after expenses. So in case of finance companies, these will all become operational revenues. So here, 1% of total income or 1 lakh, whichever is lower, that has to be disclosed separately. While we are mentioning employee benefit expenses, we have to give contributions to PF, other funds, etc. separately. Then any ESOP expenses or share purchase announcements have been made by the company. Then stock purchase plan costs have to be given separately. Stock welfare costs have to be disclosed separately. Then audit fees we have to give as what is the audit fees payable to statutory audit, towards tax audit, other consulting services or any others have to be given. Here in many cases what we have seen is companies don't understand the difference between internal audit and statutory audit. So generally these internal audit fees also they will club along with the audit fees are put it there. So whether they have classified under legal and professional charges or professional fees or whatever, only the payments to statutory auditor alone have to be separately put here. Then details of CSR expenses which they meet. Finance costs will include interest expense, borrowing costs, then any forex gain or loss, translation losses, etc. will come under finance costs. Apart from that, some of the other line items which are suggested by Schedule 3 but not really exhausted, they said we can add more, are consumption of stores and spares, power and fuel, rent, repairs will be given as building, machinery, vehicle, etc. separately, insurance costs, rates and taxes which will not have the tax on income, only other taxes will come here, miscellaneous expenses, what they've given, we can add any number of other heads to this. While we are giving CSR expenses, we have to give details of what was spent during the year, what was the amount applicable, eligible to be spent, what we have spent, if there is any closing balance available, then cases where the money is available, in case of listed companies, they are supposed to be kept in a separate earmarked bank account. Within 1 month they have to be deposited and all that, so all that has to be disclosed here. And here also if you have any work done by related parties, so many companies, big companies have their own trusts which do the CSR activity also. In those cases, those also have to be disclosed. And any opening provision that is there and spent during the year, so in those cases, movement have to be given. So apart from that, we have disclosures on crypto or virtual currencies costs.
For CSR, there is a shortfall, or if I have created a provision for that, I normally put out that as a disclosure. Suppose I have spent excess, assume I need to spend only 1 crore, I have spent about 1.25 crores. The excess 25 lakhs, do I take it to prepaid expense and then set it off for next year, or is it just for the purpose of disclosure?
In the current year, when you have to spend, you can spend lesser. You don't have to take it to prepaid, you have already spent it. What you actually spend or what you are expected to spend only goes there. But in CSR, I think about 20% or something you can overspend and also carry it forward. So you don't carry it forward by way of an entry or anything. Only while doing the activity, you don't have to spend it. So any loss or profit that happens on cryptocurrency transactions, whether it is a virtual currency or whatever, has to be reported here. And cryptocurrency held at the end of the reporting period has to be given here. If any money is given or advanced for dealing or trading or investing in cryptocurrencies, those also have to be given. So I have never seen this, so I have only read about it, I'm not sure. So this is the format for the revision to financial statements under Ind AS in Schedule 3. So if you notice, it comes from non-current assets. Then you have, so non-current assets, if you see property, plant, all that, they are all basically non-financial assets. So financial assets are assets which are, basically equivalent to cash or realizable in cash or money or equivalents, for simple understanding. So these are all assets which are not in the form of money or immediately realizable. So you start with non-current assets. Under non-current assets itself, you have financial assets, which will include investments, trade receivables, loans, and other non-current assets. So essentially, these are all financial assets are assets which you will realize as cash. Like for example, trade receivables, you will be collecting it as cash. Investment, you sell and collect cash. So those are what are coming under financial assets. Similarly, under current assets also, you start with inventory, which is a non-financial asset. Then you have other financial assets underneath that, like investments, trade receivables, cash and bank balances, etc.
And trade receivables loans are of financial asset nature and it's classified both under non-current as well as current.
Depending upon the
period.
Yes, so under equity, just to put a difference only, I just put that in the blue color. So you have other equity which is only there in division 2 and 3. Similarly, you will find lease liabilities. On the asset side, you will also have right to use of assets. Here also you will see that the hierarchy is, you start with non-current liabilities, you have all financial liabilities first, and then anything non-financial will also be, they are all separately put as financial and non-financial. But most liabilities are financial in nature, except if they are going to be settled as equity or something else. So the division 3 format also I have given here because I wanted to discuss it to see what was different from division 1. So division 3 is for NBFCs and financial institutions. So basically, if you see here, the order will be by liquidity. So here we don't start with non-financial assets, we actually start with financial assets. There also we start with cash and bank balances because they are the most liquid in nature. Then we move to receivables, other receivables, loans, investments, etc. And after that we move on to the non-financial assets. Inventories, current asset taxes, deferred tax, investment property, other assets, etc. So the items are the same, but the order in which they are presented are very different in division 2 and division 3. In the liabilities also, you have financial liabilities first, so derivative instruments, trade payables, other payables, etc. Then securities, borrowings, deposits, subordinated liabilities, etc. And non-financial liabilities. So non-financial liabilities, some current tax liabilities, provisions, deferred tax, etc. And finally, we have here the equity and the other equity. So just wanted to address the difference between the division 1 and what we will see in division 2 and division 3, which are broadly coming there because of the Ind AS requirements. So if you look at property, plant and equipment in division 2 and division 3, the companies have an option to take deemed cost or as the, which is the book value of the asset or the fair value of the asset at the time of the transition. So depending on that, in the year of transition, while we look at the movement or reconciliation of the asset, if the book value of the asset is taken as the cost, then from the original GAAP accounts, while we transit, the same numbers will continue. But if we were to do a fair value or for a particular class of assets and that fair value or the revalued number is going to be taken, then if you see the asset gross block will start with the fair value of the asset. The accumulated depreciation block will have a 0 there because you have fair valued it. So the at the time of transition there won't be any depreciation on it. The fair value would have absorbed the depreciation, everything. After that only you have the fair value. So in the presentation,
you will see that an old asset which you are actually transiting into Ind AS at fair value, you will find that the market value will be reflected there. The depreciation line will have a zero, accumulated depreciation, opening balance will be a zero for the transition period. We have to mention which of the class of assets are actually revalued at the time of transition and how they have been valued, etc. So the overall, all-pervading thing across Ind AS is this fair value concept. So everywhere you have a fair value or you have a cost. Cost can also become the fair value sometimes, or whether investments are at amortized cost or whatever. So the next difference that which we don't have in Division 1 is this right to use of assets. So these are all leased assets which are taken here. So what happens is the lease is not recognized as a rental expenditure anymore in the financials. It is treated as the company having a right to use the asset. So based on the term of the lease term, basically the lease rent is converted into an asset and a liability, and the right of use of asset is actually created and shown as a separate line item sometimes in the balance sheet. Some companies also put it along with the property, plant and equipment as a separate line item in that table itself. The depreciation for this will be based on the lease tenure itself. So here also we have two options. One is prospective or retrospective, etc. So at the date of transition, whatever period is left, only for that period you can convert it. Alternately, you convert it from day one when the lease was entered, and then subsequently at the date of transition, whatever is the value, that alone you take and the balance is passed on to the transition reserve. One of those approaches could have been taken. That note also has to be mentioned in the financials while you are preparing this. So the rent cost gets replaced by depreciation and interest expenditure in these cases. The use case for this, see actually what happens is the company has an option to take it as a, continue to use it as a short-term lease, then they need not use this right to use of asset. They can continue to use it as rent itself and book the rent expenses itself. Alternately, long-term leases can be treated under this, accounted under the lease accounting. Depending on in the transition year, some voluntary transitions also we have seen where people adopted Ind AS because this expenditure actually shifts your expenditure below the line. So a rent which was above that now becomes, the EBITDA becomes better to use this method. Because of lease accounting, some companies which have had many properties on rental actually shifted to Ind AS to account for this so that their EBITDA will get better. Actually, it was a method which some companies have used. The other things why we are actually looking at it is, for example, ideally these are supposed to be based on terms of the the period of lease, whether it is short term, 12 months or so is supposed to be a short term lease, otherwise it's supposed to be a long term lease. The other thing necessity to create is, if the underlying asset is a very expensive asset, then should you create a right to use of asset? Then what happens if it is something like a computer or something which was earlier on a finance lease obligation? So how do you treat that? So these are some questions which come up when we actually adopt the standard itself and do the lease accounting. So if some, for example, a company which has multiple branches across the country, 500, 600 branches, which are probably only sales office or collection offices or something like that. It's only a plug and play office which can be replaced. You just shift the office, shift one table and one bureau and one person goes and shifts another office like that. It's a humongous task to be doing this lease accounting for them. Imagine doing 600 accounts and then doing quarterly, half-yearly review of that, re-accounting and all that. This will become one person's job, literally sitting and doing this accounting. So in those cases, companies can take a stand that they may be long-term leases, but they can be terminated at any point of time. They are all cancelable leases and they are all plug-and-play offices. Then the company can decide that it can be treated as a short-term lease. Alternately, if it is beneficial to them, some kind of a judgmental call, management has something to decide to improve the results, show an EBITDA, they can decide to do this. Capital advances will come under non-current assets, non-financial assets. Non-financial because you give the advance, what you get back is an asset, you won't get money back. So it will be a non-financial asset. Investment property is very distinctly treated under Ind AS. So normally properties where the companies conduct their business or where they have their own office can be treated as regular property, plant and equipment. Where the company lets out the property and earns rental income, etc., it will be treated as an investment property. In the case of investment property, what happens is the regular depreciation, accounting, etc. is done. However, we need to disclose the fair value of the investment property under the investment property schedule itself. So at every year end, the company has to measure the fair value of those properties and disclose it there. Not only disclose it there, it has to be done by a registered valuer. And I think the investment property Ind AS also mentions that it has to be done by a person who is an expert in properties. So it has to be a registered land and building valuer who has to do the valuation. And the details of the valuer, etc., also has to be mentioned in this under the schedule itself.
So only for the rented properties or for the retail properties?
No, not rent. Yeah. What you let out on rent, yes, for those. So whatever you are not using for your own factory, building or something, those will come under your property, plant and equipment. What are let out, so those will come here and those disclosures are to be made. So the other important thing, because we are talking about Ind AS, all the financial assets take a lot of prominence because quite a bit of work to be done there in terms of disclosure, in terms of fair valuing. Then there is a hierarchy to say how the fair values are being derived, etc. All those have to be disclosed. So under all financial assets, we have to classify it as whether they are coming under amortized cost or whether they are treated as fair value through P&L or whether they are treated as fair value through OCA. So generally, amortized cost in the case of investments will be, say, investments in your subsidiaries, holding, joint ventures, associates, etc., where they are all strategic investments and every year you are not going to be looking at their value, those will be amortized cost. All other investments like mutual funds, public market investments, everything will generally be treated as fair value through P&L only. But sometimes, specifically, the company, there is some kind of a, there's a kind of a volatility in the value, in the fair value of a particular investment, and they don't want to route it through the P&L, etc. I think the board can take a call to specifically designate it as fair value through OCA. Otherwise, it will have to be routed through P&L. So every investment, every asset, in fact every financial asset in these balance sheets will have to have either a columnar approach to say whether they are accounted as amortized cost or FVTPL or FVOCI, or alternately one below the other, each of them have to be given specifically to say under which category they are classified. So here what happens is, unlike Schedule 3 for Division 1, since all the assets are fair valued except all the investments are fair valued except for the subsidiaries, etc. Separately, you don't provide for a diminution or anything because the fair value automatically takes the diminution or the appreciation into account, and it gets accounted in the P&L. So there is no necessity for a separate loss booking or anything. So the fair value changes in the investments in both appreciation and depreciation get passed to the P&L. Separately, it is not required. We have to give details of individually the number of shares that the company is holding, the percentage of holding, what is the cost, what is the fair value, what was the fair value last year, what is the fair value this year, holding last year, holding current year, everything. A detailed list has to be given. So here, we still have to give what is the total value of quoted investments, etc. But anyway, in the the division 1, we will only give finally one line saying market value of quoted investments is so much. Individually, we may not be giving line by line, etc. But here, because of fair valuation, anyway we are giving item by item. It is available there, and we also give the totals. In the case of investments in subsidiaries, etc., what happens is generally they are accounted at amortized cost, which means that because they are strategic investments or whatever. So in those cases, we have to do a consolidation of the accounts. But in rare instances where the companies opt to account these subsidiaries or associates or joint ventures at their fair value or market values, then since the market value or fair value already takes account of the company's performance and everything, the consolidation is not required. So there is a option available not to consolidate if the accounting for subsidiaries, etc. happen at fair value.
Okay, please go to the page slide. Please. You are mentioning the expected credit losses on investment in subsidiaries to be accounted and disclosed. How can we arrive at such things?
Credit loss of investments. So sometimes we have loss-making subsidiaries. So generally, subsidiaries are accounted only at amortized cost. Generally, we call them as strategic investments, and we don't want to account for their losses. We keep them, hoping that they will revive, etc. But sometimes what happens is, if the management decides to provide for the losses, then in those losses you have to estimate the fair value of the subsidiary, and then determine what is the loss in the carrying value, and you have to account for it. And while we account for losses in subsidiaries, any loans, advances, etc. which we have given to the subsidiary also has to be impaired. So while we are giving the fair values for all the financial assets, there is also a disclosure which is required on the hierarchy, which is level 1, level 2 or level 3. So how are we determining the fair value? Level 1 is observable inputs, which means it's a listed company and we have the market price which is directly available in the stock exchange. So we have taken the BSE or NSE price. In those cases, we can just put level 1. We don't have to give any explanations. Now level 2 is when for unquoted entities, or sometimes debentures, bonds, etc. some FIMDA or some site or somewhere else, it is not really listed, but from some other site we are able to get the data, or in some cases the company themselves will declare some NAV or something like that, but it is not really from the market directly. Then it becomes a level 2 input. Level 3 is totally unobservable, so probably you actually put one valuer to value a private company or something and then take the data. So it is an unobservable input. So in these cases, we have to actually disclose for each financial asset. This we have to give for even cash, bank balance, etc. also. But more so for investments, because that is where valuation is actually required. What happens is for all other financial assets, trade receivables, cash, bank balances, etc., the book value is actually a reflection of the fair value, because that is exactly the money you will get outside also. What realizable and this is the same. So we generally in listed companies you will see one note saying that they are all the realizable value or the book value is treated as the fair value and left at that. But for investments you will see some detailed disclosures on all this. So if you are not using the level 1 inputs, we have to give a justification and a note to say how we have arrived at the fair value. Apart from this, India also talks about investments in structured entities. So I have not seen structured entity. So this is actually a definition that I carried. So a structured entity is something which is decided so that voting or similar rights are okay. So in these cases, voting does not decide the control you have. Apparently, the board has a control indirectly, whether they hold or not. In some cases, we are able to control another enterprise. So in those cases, also under Ind AS, consolidation and everything happens. So where the board controls the board of another company, or the activities of some other company is controlled by this company's board, etc. Though you may not have any shares or investments in that company, since the operations of that company are controlled by this company, those transactions are also treated as investments, and they also get consolidated. So in the case of partnership firms, etc., if any holding is there, then the details of the holding, capital balance or the profit sharing ratios, etc., have to be disclosed. And if the partnership firm maintains a separate capital account, current account, etc., then only the capital balance has to be given. But if the firm does not maintain separate accounts, then the net sum of all balances in the partnership firm has to be disclosed here as one number. Any application money that the company pays towards acquiring investments again is a non-financial asset. It can be current or non-current depending on when the investments will be awarded to the company. So trade receivables as an area, commonly with loans and advances for NBFCs, or there also sometimes they are called as receivables. Basically, the difference between Division 1 and 2 and 3 is we give the aging, etc., which are given for all companies. So here also they are given. But apart from that, we also have to work on the expected credit loss provisions. So there are a couple of methods how these are computed for trade receivables. So in normal companies, we have a general approach and a very simplified approach, which only looks at to say, you look at data saying in different buckets of aging and see how many of them have slipped to the next bucket. Very simply, you can say 30 to 60, how many of them went into 60 to 90, from 90 to 60 to 90, how many of them went into 90 to 120 or whatever. So, in each succession, across period, we can look at some kind of an estimate to see how many of them move from one bucket to another, and finally how many of them have actually not been collected at all. And you derive at some kind of a loss, and you make a provision for that. So, that is a very simple approach that we can take for debtors in case of other entities. In NBFCs, receivables are a very big number for them. The business itself is only lending and all that. So there we have to go by a more complex method of recognizing this. So broadly, if the difference is that in the past, all the debt provisions are based on past experience when they have actually gone bad, or that one particular debtor you are not going to collect. Only we make provision only for those debtors. So we don't make a provision based on some kind of a probability estimate or anything like that. But while we move to Ind AS, we are not talking from the past experience. Using the past experience, we are making a futuristic estimate to say how much will be the loss. So the difference is that the loss provision will not be actually equal to a bad debt, it will be something more. Very similar to what under prudential norms in bank, where you make some 0.25% provision for standard asset or something like that. So standard assets are good assets today, but tomorrow you expect that something can go bad and you make a small provision on it. So this is exactly similar here, except that now we have a fancy name, expected credit loss. So I'm not sure what. I think this illustration or something came there. So basically we look at receivables or loans and advances as three categories. One which are very good and there is no credit risk at all. The next one is there is a significant increase in the credit risk or there is a slight increase in the credit risk. And the third one is the loan which has gone or the receivable which has actually gone bad. So they are the credit impaired cases. So for debtors, what we can do is, if there is no significant financing component and it is just a pure trade receivable, we can use the general approach. So you only do a rough estimate of saying how many loans you started with have gone bad over the years. You have some kind of an estimate based on which you make a provision. This provision does not necessarily, you don't have to split it into three buckets or anything like that, as credit impaired, significant increase in credit risk, etc. So you go by the old thing like good loan or bad loan, a good loan and a doubtful loan, and you make an overall provision. In this provision, you don't have to give the breakup of the provision for each of the stage. So that is a generalistic approach. So the table here is if it is considered good, secured, unsecured, and then whether there is an increase in the credit risk and whether they are credit impaired. And against that you have one loss allowance. So this loss allowance provision will not go and reduce my debtor account itself. It's a separate provision which is kept and will be adjusted on the face of the balance sheet as a loss allowance against the receivables.
Is this compared year after year? I make a lower provision, but actually my estimate has been wrong. So it actually increased subsequently next year. How do I capture that in the subsequent year?
So what we normally do is we take data across 3-4 years, not necessarily for 1 year. Like for example, one way to do is like this. So for every quarter or every half year or whatever, depending on what the data is available, you can actually put them into different aging buckets. So then, in the first, the bucket has to match with the quarter or whatever for which you are checking. So for example, first 90 days, how it goes into the next 90 days. So supposing you have split into quarters. So 0 to 90 day debtors, what percentage of them slip into 90 to 180? And then from 90 to 180, how many slip into 180 to 270 or 360 and beyond? And then some of them finally are totally not collectible at all and they have actually gone bad and you are writing off. So if you start from 0 to 90, you know finally that you started with say 10% which slips into next bucket, from 10 another 5% slips or whatever, and finally maybe 1% of what started here has totally gone bad. So based on that you make an estimate. You can make an estimate based on average. Year on year you find that it is increasing or decreasing, you can adjust.
Anybody really verifying or finding some valuable input from this to change the credit policies of the company and all? I have. Okay, my personal experience is just not to comply with the requirements. You put that into some buckets and do without really applying. Actually, what happens is my personal view.
I have done it for NBFCs. So I have done expected credit loss model for an NBFC. So there what we did was, because NBFCs are also coming under the prudential norms and they are also coming under the aging category, etc. For example, until the Ind AS came, anything beyond 90 days was called as an NPA, etc. So generally the starting point for NBFCs mostly is that 90 days, after 90 days overdue, it becomes credit impaired. So here what we tried to do was, we took 8 years data and we tried to map this movement across the years to say from the origination of the loan till the loan is matured and whether you collect or you don't collect or how much you have lost. Sometimes you lose, then you get back the money because you continue to pursue them, you will collect the money later on after they become an NPA or after it is goes out of the books also. So basically based on the Basel norms, we have a formula for the NBFCs, etc. to say we call them classified in a stage 1, stage 2 and stage 3 loans. So stage 1 loans are good loans or standard loans. Stage 2 loans are loans with increased credit risk. And stage 3 loans are our NPAs, basically. So based on this data which the company has, month on month, year on year, you work for 8 or 10 years and then you finally find that actually while a loan is in stage 1 consistently for many months, the probability of it actually going to an NPA is only say 0.1% or 0.2%. But loans which quickly slip into stage 2, which is the high credit risk impairment, we will find that about 30 or 40% of them will actually become credit impaired. The test for us to say, like what you are saying is, what is that aging? Should it be 90 days or should it be 30 days or should it be 60 days or what? You can see by seeing how many loans are backtracking and going back to a good loan. Like for example, one borrower defaults for 2-3 months. Then he will actually go back. Somebody who defaults for 60 days, many times, after a couple of months, he will actually pay and go back to the 30 days bucket. Whereas a person who goes to the 270 days bucket or something, he will never come back. So assuming the company is calling 90 days or 60 days as their NPA date, you decide which is an NPA date or a default date, depending on if they are able to come back, then that is not the NPA date. The period beyond which they will mostly not return back to a good bucket or a better aging. Based on the statistics that you take, the number and all that you can decide. So in our case, for the company which we did, we actually shifted the 90 days to 60 days. Because we found that any loan which was going beyond 60 days was not returning to 30 days. Their collection period is of 15 days or something, every 15 days. So 90 days is too much. Somebody has not, every 15 days collection, somebody has not paid for 90 days, that means we are talking about 6 collection cycles. So if they have not paid by them, they will not pay at all. But what we found was 45 days, somebody 3 cycles, they were coming back, they were slowly coming to 2 cycles or something. But beyond 60 days, we found they were not coming back at all. So we actually told them to amend the policy to say that stage 1 will be 15 days, stage 2 will be 15 to 60, and stage 3 will be 60 plus, something like that. So based on, but this also will change depending on the business. If they change their collection cycle, this will change. And then, situations like demonetization, situations like COVID was very bad, obviously everybody went bad. So those are situations where you can find out. In NBFCs, the further problem is like what happened to that Bandhan Bank, or I think it was Spandana or something in Andhra. Because one fine day the politician said, you need not return the loan. So in Bandhan Bank, I think it happened in Northeast. I think Assam and other places, they said you need not return the loan. Bandhan Bank's exposure was fully towards the NBFCs or microfinance companies which were lending in Northeast. So the downfall, or when Bandhan Bank went bad, it was because lot of political unrest and announcements in those areas where they said, okay, you need not repay. Every time the elections come, something like this, somebody will tell, some companies will this. I think it was Spandana only in Andhra, no Ashwin? Ashwin? Spandana. We found that they had gone bad because their politicians said, okay, don't pay. One fine day they announced, don't pay the loan. I think next day all the loans went bad. So such rare things also will happen. But generally we can see we can eliminate those times to see as a regular business whether anybody will come back. Even in companies also, like for example, manufacturing companies, your exports will have a different set of credit period. Your local customers will have a different kind of credit period. So we cannot have one policy fitting everybody and all that. So for exports, if you are going to say 6 months is the credit period, then you cannot make the same computation as that for the regular customers and say provision policy cannot be uniform. So companies have to actually sit and apply their mind and thought and actually do this kind of computations so that it does not affect them also very badly, because sometimes this will lead to over provision because it's an estimated provision, it's not based on this. And they should also have proper data on how they are able to collect, etc. So today what you think will fail, tomorrow you are able to collect, then obviously you can re-estimate to correct it also.
We have to group data analysis in a particular category, and for each category
we have to separately do it, correct. In fact, these are done sometimes based on businesses, based on geographies, based on credit periods you give, based on products. Because these credit periods will differ depending on different business strategies, etc. So actually there is no necessity to follow only one policy for one company or anything like that. For each of them you can individually determine. In disclosure it can be together, but separately it can be determined and then added together to bring them up with them.
These expected credit losses are required by the accountants of the company, or the auditors are expected to prepare?
Companies have to prepare, but
We have to wait it.
we have to wait it. But companies which employ chartered accountants are able to prepare such things, particularly if somebody is getting these updates and who are learning and other things. But other companies who don't have CAs or who don't have people who are updating themselves with all this, they generally outsource it to some consultants.
But many UK-based financial institutions, following as you mentioned, Basel and they have multiple varieties of reports, NFS status, and on day basis also they used to prepare.
Correct.
I don't know much about our Indian banks and all, but they are following.
No, actually, if you see, these are all looking, these expected credit loss provisions are based on forward-looking information.
Yes, sir.
Actually, in India, we don't have forward-looking information.
And based on the
We don't have forward-looking information. That is the truth. If you even look at demographic statistics or something, our statistics will be 2005, 2010 or something like that, 11 or something. By the time we get any statistics, it is too late. And though these are all adopted from IFRS, not in fact US GAAP also adopted it much later if I am right. Actually, the data available with us is not fully, you cannot correlate it fully also. Like for example, you should be able to see a relationship between these forward-looking statistics and the business. Then only we can correlate and come to some conclusion. So for example, if unemployment increases, if they are going to say that unemployment rate is going to be very high, then what we will find will be, you can correlate to, for example, if you are doing a ECL for credit card loans, then you will know that there will be a lot of defaults. So that kind of data is not available yet in our country for public consumption, definitely. Whereas if you see US companies or UK companies, like you are saying, those companies have all this in their accounting system or their credit system itself. The other ways they are suggesting is that you can use credit rating agencies. Based on the credit rating, you can decide whether your customer will pay or not. Or based on that, you develop a model to make the provision. Such things are all there. But the other thing we have seen here is, for example, in housing companies, on the one side there is a heavy security which is available because the house is mortgaged. On the other side, if you see in a housing loan, as the tenor increases, as the borrower pays the money, he stands to lose if he does not repay the loan, unlike other loans. Because the value of security compared to the loan to value, the value of security will keep on increasing as the loan tenor increases. So for example, first year of loan, maybe they gave 80% loan against the house. Now after repayment of the loan, on the one side real estate value would have gone up, on the second side you have already paid the amount. So the security value actually keeps increasing compared to the loan. So in housing companies, if you see, the provision will be, this ECL provisions will be much lower compared to companies with unsecured loans. There also, if you see Bajaj Housing Finance, I think they are, they have this low-cost housing models. Then, depending on which kind of housing they are financing, etc., there also you will be able to see a difference. And in case of credit cards, etc., when we are doing the ECL model, I have not done a model, but many times our cards are not fully, like for example, you have a limit for 1 lakh or something. You have not fully drawn the limit. You have drawn only 50,000 or 25,000 out of a credit card. The remaining is an exposure which can be drawn at any time. But actually on the date of the balance sheet, it is not a loan. But actually there is a model to say that you have to look at the probability of how many of those people who have not drawn their limits will actually fully draw and also not pay. So in those cases, the expected credit loss is done for an amount which is not even a loan at that point of time. Other cases, at least it is a loan. In credit card, I have a limit of 50,000. I may always draw only 10,000 or something. So my rest of the is only an undrawn amount which is available for me to draw. It's not a loan at that point of time. So even in those cases, we have to make a ECL. So today, I don't think we are matured enough to get all this and make these provisions. And at least with the big fours, I have seen a model where we make a provision. They tell us to backtrack and check the next year to see whether the provision we estimated in the current year is correct or not in the next year after you have actually actual numbers. Like you are asking what happens in the next year, we make an estimate, it goes wrong. So in their audit procedures, we have seen them check something like this. I don't know whether anybody is before they can vouch for it if you've seen it. You see that, right? So that we have seen on the other side. So they come and tell us, okay, this last year you made this estimate, now you tell us how correct or wrong your estimate was in the last year and whether you have to correct it this year. So in the case of NBFCs where this detailed estimates are made for expected credit losses, so there is a loss provision for stage 1 which is the good loan. There is a separate loss provision for loans with increased credit risk, and there is a loss provision for credit impaired loans. So all three stages, stage 1, 2, 3, they are called, all of them we have to give a separate reconciliation from opening to closing, including all receipts, adjustments, write-offs, whatever happens. And similarly for the provision also we have to give a reconciliation between the opening to closing. So in case of trade receivables in companies, etc., we don't give that kind of a detailed movement for each stage and all that. You only give an overall loss. So that is the difference between Division 2 and Division 3. And in NBFCs, if we find that the RBI provision which comes from the prudential norms is higher than the ECL provision which we estimate, the company also has to create a separate reserve for the difference amount. So apart from that, we have an Ind AS 115 which talks about contract assets. So if we have a contract with a customer to present a contract asset, then in the balance sheet that asset also has to be separately identified. So for this also, like trade receivables, we have to give disclosures. And if they are credit impaired, etc., those also have to be checked and disclosed. Security, unsecured, good, bad, all that has to be disclosed. So other advances which are current or non-current, non-financial assets. So these are like prepaid expenses. For example, we have already paid the money. We are only going to enjoy the benefit. So that is a non-financial asset. Similarly, all service tax, VAT, NVAT credits, service tax, GST, capital advances, etc., all that will be accounted under either current or non-current non-financial assets depending on the period. In cash and cash equivalents, separately we have two heads for division 2 and 3. One is cash and cash equivalents, which will contain bank balances which are also nature of cash and cash, which means there is no lien, margin, nothing, and then they are not in deposits, they are just current account balances, etc., which will come here. Then you have checks on hand, drafts on hand, cash, etc. Apart from that, you also have a separate line called as bank balances other than cash and cash equivalents, which will be disclosed below the cash. So what do these contain? These will contain these margin money, security, lien marked deposits, etc. And also here, there we are only giving maturities more than 12 months. Here we have to give between 3 to 12 months and more than 12 months separately disclosed. So all financial assets which do not fall under any other category will become other financial asset. And current tax assets. In current tax assets under Ind AS, one thing that we have to see is, generally what happens is all the past years we will have some TDS or advance tax which is pending and which is available as an asset balance. And only for the last year which we are auditing and closing the accounts, we have a tax provision. So generally companies have different practices. They set off all assets and liabilities and show it under one place only and keep a breakup in their books or whatever. Ideally, we can set off an asset and a provision only if the department will allow you to do it. So, for each assessment year, you have to look at the asset value and the provision value. So, for example, there is a provision to be made for 1 year and there is a TDS or an advance tax which is available for another year. Income tax department actually will not say no need to pay tax for this year because already there is a TDS for the previous year. For every year we have to separately pay tax, separately have a TDS and a provision. So under Ind AS what happens is only when the authority will allow you to set off something like that, you can actually adjust the asset and the liability, otherwise they will have to be shown separately. So in this case what happens is you have to put year by year what was the TDS or advance tax, what is the tax provision. So for some years if you find that the advance tax is more, only that can be kept in the asset side. For some other year the provision is more, that has to be kept in the liability side. So the workings have to be done like this. And in the case of Ind AS, the issue is, supposing this year you have decided to show or disclose it in one form, and the next year you want to regroup or whatever. So generally we have this clause in the end of all the balance financial statements. In the notes we say previous year figures are regrouped wherever necessary. That regrouping cannot be done under Ind AS. If you have to do that, you have to actually restate the entire financials and put it. You cannot regroup now for something in the past which happened while you are disclosing some past year accounts or last year accounts. So similarly, you don't have any prior year adjustments and corrections happening. If you have to do that, you have to go back to that year and correct the financial statement in that year, and then show that as a reconciliation item in your equity, saying that prior year adjustment was made. So these are some things which are very differently done under Schedule 3 for Division 2 and Division 3. So other than this, coming to equity and other equity, so you also have a statement of changes in equity which talks about all the adjustments that have happened to equity. So apart from opening and closing, any issues, adjustments, bonus, buybacks, all that will come. Apart from that, changes in equity capital due to prior period errors. So any errors or adjustments we make in the current year, in the previous years, generally here in the P&L we will normally, put under the expenses. We just put one line item saying prior period expenditure or something. That is not permitted here. You won't adjust in the prior year, and that item you show as an adjustment in the equity. Restated balances at the beginning of the current or previous reporting period. So because of this, the current year opening balance gets restated, and from there you make the reconciliation for the current year. Other equity will include items like share application, money spending allotment, equity component of compound financial instruments. Will compound tax component attached to that. So the adjustment has to be done in OCI for the expenditure or the income that is accounted there, along with the deferred tax adjustment, and that will come under other equity. Here also you have to prepare a reconciliation statement from opening to closing. Now, one curious case of things that we will see between the Ind AS and the regular accounting standards is the treatment of compound financial instruments. So normally we call preference share capital as part of capital. We put it under authorized capital and equity, etc. Along with the equity, we put it under share capital in the regular financial statements. Here, depending on the nature of the preference capital, they can be treated as a liability or they can be treated as an equity. So basically, if an instrument is a fully convertible instrument, then it takes up nature of equity and it gets accounted along with equity. Supposing it is an interest-free preference capital or an interest-free loan or an interest-free debenture or anything like that, even a security deposit, for example. So the interest-free component, only the equity holder will give something interest-free to the company. So any interest-free component or instrument will be treated as an equity component and will be accounted under the equity. So what happens is a redeemable preference share carrying interest will be treated as a liability under Ind AS, while it is treated as capital in the regular financials. So all compound instruments we have to analyze and split them. Some of them you have to split them into equity component and liability component and account them under the respective places. So other current liabilities will be revenue received in advance, which will be a non-financial asset. Then amounts received in advance from customers for investments or capital assets or immovable property, statutory dues payable, legal claims, trade deposits, etc. All these will be other current liabilities. In the case of P&L, one difference that we have to see here is, since we have an amortized cost and a FPT PL, any income that is received from financial assets will have to be shown as, interest on investments at amortized cost, interest on investments at TPL. So that segregation has to be shown in all line items of income, where it is coming from, whether it's an amortized cost asset or whether it is an FETPL asset. So that distinction has to be shown in the P&L schedules. Most of Schedule 3. Thank you so much for patiently going.